The Rebel Capitalist Show.
I listened to one of your recent interviews and you were talking about the housing bubble, but then you juxtapose that to like the Buffett Indicator, the CAPE ratio, and all these other metrics. And then you also talked about the bond market, interest rates being at 5,000-year lows, therefore prices being at 5,000-year highs. And although we had a housing bubble back then, we didn't have all these other bubbles in addition to that. So now, I guess my first question would be, how is what you're seeing today in markets from a psychological standpoint similar to what you saw with just the housing bubble in 2006, 2007? And then how might it be different?
Well, this is like I call it a triumvirate of bubbles. We've never had a bubble in real estate, equities, and fixed income concurrently. Never. And by the way, all those bubbles are pretty much at a record high. So
Yeah.
home price to income ratio is back to where it was at the apex, leading up to the credit crisis and the housing crisis and Great Recession of 2008. Actually, December 2007 is when it started officially. From the NBER, they officially call recessions. And of course, I love the Buffett indicator. We're now at over the market cap of equities is now over 200% of underlying GDP growth. That has never before happened. It's not even close. If you look at where we were in 2007, right before the S&P lost half of its value, we were at 100%.
Yeah.
And even in March of 2000, we were at 140% of GDP. So you have a massive bubble in real estate, an unprecedented bubble in equities. And then when you look at fixed income, I mean, when in the history of mankind, going back to like the apes, have you seen negative interest rates? So the government gets paid to borrow money. And in some cases, the corporate bond market, corporations get paid to borrow money over in Europe. So 13 trillion now, the high watermark was 18 trillion not too long ago, and now we're down to 13 trillion. But I mean, I think we can both agree that interest rates are at the sub basement of history. And the problem I see is that you have all of this new debt being piled on, corporate debt, sovereign debt, and that debt can only exist. It's only viable. It's only solvent in the context of having interest rates that are very, very low, practically free. Mm-hmm. So the average interest rate on debt in the United States that the Treasury had to pay on that debt was 7%. It is now just 2%. Of course, that gives us a semblance of solvency because, hey, interest payments are pretty low. But they're only pretty low. Debt service costs are only low because you've taken interest rates down 500 basis points on average on that debt. So if we had to pay an average interest rate on the debt in the United States, our interest on the debt each year would be $1.9 trillion. Almost $2 trillion just on the interest of the national debt outstanding. It is mind-boggling because our deficits are already 15%, 16% of GDP and going higher. And that's in the context of ultra low interest rates.
Yeah.
So what happens when that rate is no longer there? That's a question you have to ask yourself.
Yeah. You're talking about that at a sovereign level, but it's my understanding that the corporate debt is at all-time highs as well. And the Fed has just created this moral hazard, in my opinion, because back in March 2020, they came in and bought corporate bonds. They bought junk debt through these special purpose vehicles. So if you're the corporation, what do? You just load up. Mm-hmm. And sure. So we see. So what would happen to the corporate bond market if rates there became normalized, or we actually had a market rate for junk debt and corporate bonds?
Well, 1 out of 5 companies now, George, is a zombie company. They have to float out they have to borrow money to pay interest on existing debt. So you look at this statistic. Junk bond yields, the average, not triple C, just junk bonds. The average yield in junk bonds is 4%. That's the average yield. I mean, you're talking about a yield on jump bonds that is 300 basis points below where treasuries normally should be, which is around 7%.
The risk-free rate.
This is just all gives you a context of how huge this bubble is in the bond market, and that's the predicate for everything, though. So how do you judge what the PE ratio on stocks should be? Well, it's what's the risk-free interest rate, benchmark interest rate now, which is ridiculously low. So how does that affect the housing market? Mortgage rates. It's all based upon the Fed's artificial manipulation of the sovereign bond market and the corporate bond market down to record lows. And I just here's my thought process here, George. The Fed purports to have this omniscience about where interest rates should be. This idea that they understand what the cost of money should be. And then they take it a step further and say that they understand how to control that rate perfectly. So they say, well, we want an inflation rate that is 2% and maybe even higher than 2% for the duration that it was below 2%. When in God's good earth has a central bank been able to control interest rates? First of all, the central bank of the United States from 2008 till today has had a very difficult time engendering a 2% inflation rate the way they measure it on the core PCE price index. Okay. So then they come out and they tell you, well, once we hit that rate, we could just stop whatever the heck we're doing and have it stay there at 2%. That's ridiculous. That has never happened before. Think it back into the 1970s. Well, I'm sure that the Fed didn't want interest rates going much higher than 2% or much higher than 5%, wherever they were back then at the beginning of the 1970s. But the inflation interest rates went to 20%. So the idea that they can just stick the landing on a certain interest rate is ridiculous. It's not verifiable economically or historically.
We talk about being in the everything bubble. I think most of my viewers and listeners totally understand that, but they always have the question, what do I do? And my framework for I'm not a pro for investing is very simple. I just say, okay, well, I just try to buy stuff that's cheap and sell it when it's expensive, but it's very long term. If you're someone who's trying to get maximum returns from 3-month period to a 6-month period, you're not going to be able to do that. And I know that's what you specialize in. So as far as you've got this 20-point kind of model that you use for making more short-term trades. Can you give us a summary as to how that works?
So it's called the Inflation-Deflation and Economic Cycle Model. There's 10 components for the inflation-deflation dynamic, and there's 10 components for the growth and recession dynamic. So it just basically asks the question, are we as an economy, both the United States, the G3 countries is what I look at. So I look at United States, European bloc, and China. Those are the 3 main countries that I look at. And I ask myself, are these countries, are they growth and inflation accelerating, or are they decelerating? It sounds both simple and complicated at the same time, but it's all based on calculus. So, that's the secret to the world, how the world works. So I just want to know, I don't want to know basically if we're going into a recession so much. I just want to know if we've reached peak growth and inflation rates here in the United States. That's currently what I'm asking myself. And the answer to that question is probably yes, depending, of course, upon fiscal and monetary policies. We have Joe Biden right now has proposed President Joe Biden has proposed in the first 100 days of his tenure, $6 trillion in spending, new spending. Now, from March, I'm not trying to get political here, because from March of 2020 to March of 2021, then President Trump had $6 trillion passed in various forms of stimulus, fiscal stimulus, which is never stimulus in the long run. In the long run, it's mostly stagflationary and actually hurts growth and engenders more inflation. And so the question is, can he pass another $6 trillion this year? I don't think he can. I don't. I think it's impossible because he doesn't have that kind of room in DC to do that. So I think that the rate of growth will slow in the second half of 2021. I think we're headed towards a monetary cliff in 2022. Don't forget, the Fed is now printing $120 billion a month. That's $1.44 trillion a year. Now, $1.44 trillion a year sounds like a lot. Let's say $1.5 trillion sounds like a lot to counterfeit in a year. That's actually a reduction from what they did in 2020. The Fed has expanded its balance sheet by about $3.5 trillion in 2020. As a matter of fact, they printed $7 trillion in confetti, in phony money, since 2008. So I look at these dynamics when I manage money. I have, like I said, 20-point model. I look at various 10-2 spreads, break-even spreads, the level and direction of real interest rates, LIBOR spreads, LIBOR OIS, junk bond spreads. So it does get a little arcane, but it's kind of like measuring and analyzing the economy like a scientist would. And so I can determine what cycle we are in and what cycle we are headed in based on those model components.